So if you hold the stock market, you will, not to be corny, Bill, but you will grow with America. The correlation between the long-term growth of America's gross domestic product, so-called GDP, and the stock market is something like 95. But the annual correlation of those two things is probably 20.
Are you ready to discover the key to growing wealth alongside America's economic prosperity? Hey there, welcome back to Cash Baggy. In today's video, I'll delve into Jack Bogle's buy and hold strategy. Join me as I unveil the secrets behind this powerful investment approach, allowing you to align your financial success with the nation's growth. Let's get started. Jack Bogle once said, "Successful investing boils down to a simple strategy. Buy and hold the stock market for the long term." This perfect line him. If you hold the stock market, you will grow with America. Jack Bogle is a legendary figure in the world of finance, known for founding the Vanguard Group and pioneering index fund investing. He's right about the long-term correlation between the stock market and U.S. economic growth. It's easy to get caught up in the emotional roller coaster of market fluctuations, especially during major events like financial crises. But Bogle's wisdom reminds us that staying the course is the key to success in investing. Trading in and out of the market might seem tempting, especially when trying to time the highs and lows. Still, as he rightly points out, it's a surefire way for our emotions to defeat us. Short-term bets can be incredibly risky and stressful. Instead, Bogle encourages us to maintain a steady commitment to the market, regardless of short-term turbulence. This advice is not just about finance, it's about discipline and the long-term view, which can apply to many aspects of life. So remember, in the face of market uncertainties, it's best to stay at a certain level and let time do its magic.
Buy and hold for a stock is one thing. Buy and hold the U.S. stock market is quite a different one. What do we have going for us in the U.S. stock market? Leaving aside how hard it is to pick the winners, how few people really ever heard of Amazon 25 years ago, to say nothing of Google, maybe a little more than that, maybe 30 years ago.
Jack Bogle's perspective on this investment approach highlights the inherent difference between short-term speculation and long-term wealth building. Bogle's point that picking individual winners can be extremely challenging, and that many of today's giants, like Amazon and Google, were once obscure, emphasizes the unpredictability of the market. Moreover, his correlation between America's long-term GDP growth and the stock market's performance underscores the idea that investing in the stock market is, in essence, investing in the country's economic growth. This perspective offers investors a sense of alignment with the nation's prosperity over the years. Jack Bogle's emphasis on long-term investing is both wise and pragmatic. It promotes a patient and disciplined approach to wealth accumulation, which can help individuals weather market volatility and capitalize on the historical upward trajectory of the U.S. stock market. While short-term market timing might appeal to some, Bogle's assertion that it's not a reliable strategy resonates with the idea that sustainable and steady growth often requires a commitment to a well-diversified, long-term investment strategy like buy and hold. So, what is this buy and hold strategy that Jack Bogle swore by? Well, it's quite straightforward. It involves buying quality stocks or index funds and holding onto them long-term, regardless of market fluctuations. Jack Bogle emphasized the importance of patience when using the buy and hold strategy. He believed that staying invested for the long haul allows your investments to weather market ups and downs, ultimately leading to substantial growth.
There are areas of the exchange-traded fund market in particular that could be very much subject to the same kind of pressures, liquidity pressures that you're talking about. When you get into the main part of the index fund market, the S&P 500, the total U.S. stock market, is not really conceivable because they are the market. And if there's a panic there will be a panic everywhere by definition.
Jack Bogle's response to concerns about the potential liquidity crisis and its connection to passive investing, as mentioned in J.P. Morgan's note, offers valuable insights into market dynamics. Bogle's candid and insightful feedback sheds light on the issue's nuances. He acknowledges that there are areas within the exchange-traded fund market that could face liquidity pressures during market turbulence. However, Bogle points out that the risk of a liquidity crunch is not as conceivable when it comes to major index funds like those tracking the S&P 500 or the total U.S. stock market. These index funds represent a substantial portion of the market. In a panic, it would be a systemic issue affecting all investments. Bogle's observation that such concerns may be an attempt to undermine the credibility of index funds in favor of active management is particularly noteworthy. He suggests that some critics may use fear tactics to promote active management, even though, as he implies, the evidence suggests that active managers often struggle to outperform the market consistently. Jack Bogle's response offers a balanced perspective on the issue, emphasizing that while there may be specific areas of concern within the ETF market, the broader impact on major index funds is less likely. It underscores the importance of careful consideration and diversification within one's investment portfolio while being cautious of potential biases in the financial industry.
Right. Every bear market is different, and there are a lot of signs of exposure in the market, but I think nothing right now that would cause me to get out of a long-term investment program, and certainly nothing that would stop me from continuing to put away my $100 or $200 or $500 every month in my 401k or my IRA thrift plan.
Jack Bogle candidly discussed the unpredictable nature of the stock market and the potential for future crises. He acknowledges that the exact timing and nature of such crises are uncertain and may or may not repeat themselves as markets and financial systems evolve. He also mentions a liquidity crisis due to rising debt levels, like student loans and home equity loans, highlighting the financial system's vulnerabilities. While some risks are identifiable, there are also hidden or unanticipated risks that can emerge unexpectedly. This underscores the importance of staying vigilant and being prepared for a range of scenarios in finance. Despite these uncertainties, Bogle's unwavering commitment to a long-term investment approach is significant. He encourages investors to build their financial future through consistent contributions to retirement accounts like 401k or IRAs. This message promotes discipline and emphasizes the long-term benefits of regular saving and investing, regardless of short-term market fluctuations. Shifting our attention to the historical evidence supporting the buy-and-hold strategy, it's important to note that the U.S. stock market has experienced numerous challenges over the decades, including significant crashes and economic downturns. Despite these hurdles, the market has consistently rebounded and displayed impressive growth over the long term. This resilience and growth illustrate the potential for investors to benefit from the buy-and-hold strategy by remaining invested in the market through thick and thin. In essence, Jack Bogle's insights remind you that while financial markets can be unpredictable and crises may arise, a disciplined, long-term investment approach and focusing on regular saving can help individuals navigate these challenges and ultimately achieve their financial goals. By recognizing the historical track record of the market's resilience and growth, investors can gain confidence in the buy-and-hold strategy as a reliable path to wealth accumulation. Jack Bogle's famous analogy, "Don't look for the needle in the haystack, just buy the haystack," encapsulates the essence of the buy-and-hold strategy. Rather than attempting to time the market or predict short-term fluctuations, this approach advocates staying invested over the long haul. By doing so, individuals can benefit from the overall upward trajectory of the market, avoiding the pitfalls of trying to outsmart it. Emotional discipline is a significant challenge for investors. Fear and greed often drive impulsive decisions that can hinder long-term financial success. The buy-and-hold strategy, as championed by Jack Bogle, encourages investors to remain calm and steadfast in their commitment to their investments. By resisting the temptation to make rash decisions during market turbulence, individuals can stay on course toward their financial goals. Let's consider how the buy and hold strategy can pave the way for wealth accumulation. Consistency is key. Individuals can achieve substantial financial milestones by consistently investing over time and allowing investments to compound. This approach aligns with the principle of patience, where the power of compounding works its magic, gradually multiplying wealth over the years. Jack Bogle's buy and hold strategy offers a proven path to success in investing. It is a strategy grounded in historical evidence, emphasizing long-term growth and avoiding emotional pitfalls. Lastly, despite the challenges and uncertainties of the market, the buy and hold approach empowers individuals to grow with America's economy and realize their financial dreams. Thank you for joining me on this journey of financial education and motivation, and remember to stay tuned for more valuable insights on my channel. Stay committed, exercise patience, and watch your wealth flourish. As Jack Bogle aptly put it, buy and hold is timeless wisdom that can lead you to financial success. Until next time, happy investing.